Larry Fink has been described by Businessweek as the world's most influential person you've never heard of, controlling more money than Germany's GDP. He's the chairman and chief executive of the world's largest asset manager, BlackRock, a $3.5 trillion business that manages billions for the US Treasury, including the toxic debt from Bear Stearns and AIG. Its latest mandate from the Central Bank of Ireland is even bigger. I spoke to Larry Fink a little earlier. Larry Fink, welcome to Late Line Business.
It's really nice to be in Australia.
You've now bedded down the Barclays BGI acquisition. Where is investment money now flowing?
It's changing predominantly because of globalization. The markets are becoming less dollar-centric. They're becoming less Euro-centric. Asset management is a global business that requires infrastructure throughout the world.
And are you reweighting yourselves accordingly in emerging markets?
We have to, but not only just in emerging markets, but we're reweighting ourselves because our clients are looking to reweight their portfolios. And that's going to be the big change in asset management companies. Most asset management companies are very domestic.
What about equities generally? Do you feel that the market is still underweight in equities?
So I think the most underinvested asset class worldwide are equities.
Notwithstanding the rise in the Dow.
Notwithstanding the rise of the Dow. You know, when you have 10-year U.S. Treasuries earning 3.4%, and I could buy some great multinational companies that are paying a 5% dividend, I mean, why on earth would I own fixed rate coupons? I also believe so many pension plans here in Australia, in Europe, in the United States, are so worried about volatility, so worried about accounting, they are underinvested in long-dated assets.
You look after a huge amount of the Fed's money. The Fed tells us that a primary role for quantitative easing is to prop up equity prices. Can I ask the Emperor's New Clothes question here, which is, how is it that quantitative easing is going to work, printing money, when it didn't work for Zimbabwe, it didn't work for the Weimar Republic, and didn't work in South America?
Well, in those countries, you did not have a universal store of wealth in the name of their currency. But I do believe, when I talk to prime ministers and government officials and governors of central banks, they are really happy with what they're doing, because this world right now is showing that we have way too much labor, not enough GDP to support labor. If people were really concerned, why on earth are we sitting with a 3.4% Treasury rate? You look at the Aussie 10-year rate, it is in the fives. And so that tells me people are still buying Treasuries despite the quantitative easing of the Federal Reserve. I actually believe what the Federal Reserve is doing is correct. We are huge supporters of it. We believe the world economy needed that. We do believe the outgrowth is a rising equity market.
That's not just creating another bubble.
By no means, but here's the issue. If we did not have solid corporations, then this quantitative easing stuff probably wouldn't work. But we now are sitting with $2.2 trillion in cash. CEOs were very reticent. They weren't spending money. They weren't hiring. The positive side of seeing a rising stock market, the attitudes of these executives are improving, and you're seeing that in all the surveys now. And you know what they're doing? They're actually starting to spend that money. And if they start spending their money with more frequency, we're going to see that in GDP, and this is why the U.S. economy is growing faster now than Europe and other places. And actually, you would then say what quantitative easing is doing is it's changing the behavior, and I don't think it's creating a bubble, because now you're seeing a rising economy to validate the spend.
Late last year, you were quite negative on the euro. Is that still the case?
Yeah, very much so. I think I don't think there's a community together amongst all the central bankers in terms of what to do. I think they are more responding to market challenges, not being proactive.
What do you make of Australia as an investment? We've had quite confusing signals last year, a lot of Asian investment in property, and then concerns and calls about sovereign risk over our mining tax and our treatment of private equity.
The opportunities from our perspective in Australia is very strong. The economy may be not as robust as it was the last few years. There may be greater opportunities in Indonesia in the next few years and Vietnam, which we are very constructive on. But a great stable, great opportunistic investing over a 5 and 10 year cycle will remain to be in Australia.
And do you see a possible merger between the Australian Stock Exchange and the Singapore Stock Exchange as good for Australia?
It is not good or bad. In many cases, it may be good for the free flow of capital in the exchanges. It may be bad for the psyche of Australia losing its exchange.
Just on US regulation, now you've lobbied very strongly to be excluded from the definition of a systemically important financial institution. Now surely your size and your influence makes you by definition important.
I'm indifferent, actually, whether we are designated as a SIFI or not. I just want to make sure there's a clear and understandable definition. We are the most regulated asset manager in the world today. We have capital set aside. So the real question for me is getting back to the reason why you had the credit crisis, and it comes down to leverage.
You're almost the Atlas of Wall Street, though. If something went wrong in terms of risk analysis, say a flaw in Aladdin, there you are holding a huge amount of America and the world's assets.
Well, we hold a lot of, we own 5% of over 2,000 institutions. So I'm not hiding from those statistics. If we are included in that definition because of our scale, I want to also say we don't have any proprietary trading, we don't use our balance sheet. 100% of our assets, 100% of our revenues are client driven. And if the definition is that we have decision-making control on $3.5 trillion, if that's considered systemically important, then indeed we will be systemically important. And as long as that definition is consistent, that other asset managers are included in that definition, I don't have a problem.
Larry Fink, a very important interview to kick off the year. Thank you very much for joining us.
Thank you very much.